I would like to remind you that we send a weekly newsletter, so if you haven't yet subscribed, please do so. The subscribe link is on our website. We also welcome any queries you have either by phone or email, so please do get in touch with us at any time. I would now like to introduce Michael Glennon, Chief Investment Officer and Founder, and Tim Powditch, Portfolio Manager.
Good morning, it's Michael here, and I've got Tim with me. So we'll kick off the webinar for the September quarter, and we'll just start off with that's the agenda of what we're going to go through. We're going to give a bit of an update in the market, talk about where we think we're at in the investment cycle, a little bit about the recent volatility that's in the market and how you can play that to your advantage and how we view that, an outlook about the market, and also things that we've got coming up. So just move forward. Okay. So just starting off, this is the Small Orders Accumulation Index in the 100. So just giving a view of how the Small Orders in the 100 performed in the Australian market over the quarter, and you can see they both perform roughly in line with each other, but there was quite a bit of variance in the middle of the month around reporting season. And so we had quite a good reporting season from smaller companies, and a lot of volatility in the 100. But partly we had the volatility in the 100 because we had the Banking Royal Commission in that period of time, and there's so much of the top 100 index is comprised of banks. It's virtually half of the index, so that explains quite a fair bit of what came out of that market. So just moving on, if we do look at taking a longer term horizon and what happened in the small cap market, you can see there's quite a few periods where the red line's the Small Orders Accumulation and the blue line's the 100. There's quite a few periods where there was a bit of disjoin between the small cap and the large cap market, and as I said, part of that is explained by banks, but part of that's also explained by strong performance of small resources and periods where that disjoined, and we'll go from the small industrials, and we'll go through some of that a little bit later on. And you can see here, this is that dispersion I'm talking about between small industrials and small resources. So over the quarter, and this is different to what's happened over the last 9 months, small resources actually underperform small industrials. Part of that was due to cost pressures. We're starting to see quite a bit of energy coming back into the small resources sector, and it was sort of a bit overdone, and now people are starting to get concerned about cost pressures, both in terms of labour, things like getting equipment, and things like that. And that's the chart of those two things over a 12-month period. So you can see, they're both trending quite different ways. You've had a very strong run in small resources over quite a strong period of time, like the last 12 months, and that started to reverse over the last 9 months or so. And just post the end of the quarter, we have actually had some, as most people know, there's quite a bit of volatility and a bit more of a pullback in the market. So the small ordinaries index is back 8% post the end of this chart, so it's quite significant.
Yeah, Tim Powditch here. How you going? Yeah, and I think we have typically not played much in resources over the last year or so, but in the last quarter we have actually found a few ideas worth looking at. Some specific commodities are looking more interesting, and the pricing's coming back. So we're always keeping our eye out, and we'll look from the next chart. I think you'll see that these are the ones that are interested us the most. Coke and coal clearly on the up, and spend in the sector is going with it. Iron ore, it's more about the kind of greenfields and brownfields development of existing mines, where production just has to increase to enable the supply to the Asian markets. Oil has been solid. We've seen a lot of rhetoric around it. Interesting fact today, looking at some stuff, that Nigeria and Liberia have been the biggest oil suppliers into the market. So whatever the Saudis say that they might be able to do to Osage, the US president, in terms of getting the oil price down, whatever the Libyans and Nigerians do could influence the oil price more significantly, and both of those countries are coming up into elections. That's usually disruptive in those nations. And finally, gold, where clearly with the markets turning down post the end of the quarter, gold stocks have been popular, and you can see there the Australian dollar gold price has been very strong.
So where we're seeing the economy, look, we've still got low inflation, we've got low unemployment, we've got historically low interest rates, and that's offset against heavy infrastructure spending in both New South Wales and Victoria, and very strong mining resource spending in WA and Queensland, in particular in coal, iron ore, gas and oil. And that's translating through to how we've got the portfolio positioned to try and leverage from some of those service providers to the resource sector. So we've got quite a lot of contractors and things like that in the portfolio. They've done very well. We've got Emeco and Mastermyne, and we'll touch on some of them a little bit later on. This is sort of where we see where we're at the cycle. There was some pretty stretched valuations in some pockets of the small cap market, so we sort of think that that's coming back off. That's further evidenced by what's happening this month, but we don't think it's going to turn into a full bear market, because as we just said, look, there's a lot of things that are going well in the Australian economy, so we're reasonably comfortable. The short-term volatility is not overly worrying for us, because most of the portfolio has got pretty solid fundamentals behind it, and attractive outlook for where those businesses are placed. If we have a look at just interest rates, and why this is important, obviously, because it affects it affects the asset prices and things like that going forward. If this is a 5-year forward yield curve of just of term deposit rates, and there's lots of different things you can look at for yield curves, but it says that the market's only pricing 3.4% term deposit rates out 5 years. So that still means that the market's pricing in Australia having low interest rates for quite some time, which means we don't think we're going to get massive deterioration in asset prices. It means that low interest rates are still conducive to companies borrowing money and growing their businesses through spending money on capital expenditure and developing projects and things like that. So in terms of, if you look at historical interest rates, a 3.5% interest rate 5 years out is still very, very attractive, and means that lots of projects are viable because you're not being burdened by onerous interest rates. So just in terms of the recent volatility that we've got in the market, we sort of want to point out that most people sell when they should be buying. The markets are always characterized by volatility. We look at the recent pullbacks as just opportunities to top up some of our investments at more attractive prices, where we're still happy with the fundamentals of the business. So there is a bit more volatility now than there has been over the last 6 months, but and we'll show it later on, markets are characterized by volatility, and you can see here's a longer term chart of what happens with stock markets, and you can see over a very long period of time economies grow. If economies weren't growing, yes, you'd expect the market to go backwards, but they do grow over time. Businesses get bigger, the size of the stock market gets bigger, so shorter term weakness in the stock market doesn't concern us. We think it's an opportunity to top up shares. It's an interesting chart we've put on here, and what this actually shows you is the grey bars are the calendar year-end returns from the market, and what the red dots underneath that are just shows the maximum sort of drawdown in the market over that calendar year. So there's many years where you've had very strong periods of returns, but at periods of time during that year the market return has been negative. So, and that's my point about buying stocks when people start to sell when the market goes south. I'd more view that as an opportunity to buy stocks. You've got to get the businesses you like at a cheaper price. And I'll just apologise for the slides keep going forward. There's some sort of weird timing on the PowerPoint presentation, but it is an important characteristic to note that you will get volatility in share prices. Look at it as an opportunity, because if you think longer term that you're buying sound businesses, they will grow, they will get better, and that shorter term volatility really is an opportunity to be picking up stock at attractive levels.
An example of that is just this year. I mean, we've just today, the Small Ords is now at a level lower than it was at this time last year, after all the gains and after all the excessive pricing that's gone on in the market, and all of that's lost within the space of 1 month, which is a pretty extreme month. But you can see where companies will bounce back.
Okay, so just moving forward, and a good example of that, this is a chart of stock we don't own anymore, but this is Silver Chef, which we owned for a very long period of time, and they had a profit downgrade, and this is from the period of 2010 to 2014. So if you look at the very right hand side of the chart, it had quite a significant fall in share price, and people start to think, geez, look, I should be getting out of this business. We didn't think that there was anything fundamentally wrong with the business at that point in time, and in actual fact, we took that opportunity of what was quite a significant share price fall off what I thought was only a short-term change in the profit result. So we took that opportunity to actually top up, and this is it. This is that share price chart, and you can see right in the middle of the chart where we've got that red balloon that says we increased our position. The stock then continued to go up for another 3 years after that. So yes, there was volatility, but if you're convinced about the business and what's happening, share prices will recover. So that was something that was noise. They missed by a couple of weeks. They missed reporting a contract. There'd been a couple of small changes within the business. So we liked that business, and we managed to hold it for another couple of years, and it was a very good return for us. And you can see there, though, when we did exit, there was a fundamental change in the business that no longer met one of our investment criteria, and that's why we exited the position, and it's gone south since then. So we waited, rather than acting on noise or something that was a short-term blip in the share price, we waited till there was actual change in the fundamentals of the business. So now just moving on to the portfolio and looking at what's contributed over the quarter. Look, Afterpay was a big contributor for us over the quarter, but importantly, we did actually realise profits through the quarter in Afterpay. We knew it was trading on a big valuation, so we virtually got back most of the capital that we put into Afterpay from the investment. Alliance Aviation, it's another business which we've spoken about before. It's benefiting from that resource sector, the strength in the resource sector. Althea was a small position we took that we traded out of. Mastermyne Holdings, one of our core positions, had a good quarter. On the negative side, BWX and Experience Co were the two biggest detractors from performance over the quarter. We've reviewed both of those positions and subsequently exited the position in BWX, though we're still watching it. Some will be aware of what happened, but we'll cover off that in a little bit more detail later on. In terms of how those stocks have contributed over the year, you can see still Afterpay has had a big contribution to the portfolio. Though so too has Emeco, Alliance, A2 Milk, and CML Group. What is important about this slide over the 12 months is you can see, though, that we do try and constrain the amount that the downside protection in the portfolio, so that we are protecting capital. We get to a point where we will review the position, exit, we can buy it back again, but it gives us that fresh look at the stock if something has changed and we've gotten things wrong. So it is an important characteristic of the portfolio that the downside is constrained. Just talking about a couple of stocks. Look, it is controversial. We've had a lot of questions about how much we own in the portfolio of Afterpay, and it's a smaller position than what most people think, because we have been quite good at taking profits. And I might just get Tim to sort of give a bit of a run through of what's happened on Afterpay.
Yeah, so we've obviously done very well out of Afterpay. We increased our position a couple of times back a year ago and less than that, and then as the updates kept coming, obviously the stock rallied. We did take profits around the beginning of July, and that's the first lot. And then we took a lot more profits when the stock hit about $21. And so really the way we're looking at Afterpay now is that we've got almost not quite a free carry, but we've sort of probably sold 2/3 of our original investment because of the appreciation in the share price. It's still a solid holding in our portfolio. And we can look at it with the knowledge that we've taken some good profits. We still believe in the story. If we go to the next table, it tells chart page. It tells us that the stock's been affected by the recent announced Senate inquiry, and ASIC's already got an inquiry into this segment. And New Zealand authorities have made a similar inquiry and found that it didn't. The Afterpay model did not harm consumers. We expect the same result here. It's not a small credit provider. It doesn't charge customers interest. The merchants pay the fees to Afterpay. There are late fees, and they are capped. But 95% of transactions don't incur late fees, and if a consumer incurs a late fee, they can't use the service. So it's not like they can rack up bills. Now, on the flip side, Afterpay's brand strength amongst consumers is very appealing to merchants. I mean, Afterpay now hold their own sales days on behalf of merchants, and that's really becoming a big event and driving sales. And in the US, where they've recently moved, they're growing 4 times faster than the Australian market at the same time after entering the Australian market, and the market's 10 times as big. The UK will launch in the sort of first quarter of calendar 19. So, they're making great strides. And if you look at, and people say, well, massive PE, but I've got research here that's new research from analysts who have, factored in the increased costs of the US and UK and the initial losses, etc. And in as far out as something like FY21, which is not too long ago, far away, that could be on a PE of around 14 or 15 times. So enormous growth off a low base. We're still happy with that stock.
Okay, so just moving forward onto BWX, which was a position we held from the IPO. We made good money out of, and we moved back into. We reviewed the position post, them missing a consensus number. But in actual fact, the earnings number that they missed, they actually met the number that management had guided us towards when we'd spoken to them. There was a couple of analysts who, had gone out and put numbers out there that were significantly higher than what the company had ever guided to. I think that's just an immaturity thing in terms of the market. John Humble obviously felt that the stock was cheap and came back with Bain & Co. and made a bid for the business. Partly why we sold out of the business, though, is one of our key things we like, is for, to be investing with owner operators. And, he has moved out of the business. So we are a little bit concerned going forward. We still think the business is good, but we are a little bit concerned about having a business where the key guy behind the business has exited the business. So we'll keep an eye on it. We like the fundamentals of the business. We like the outlook. It was only overnight. I read that Alibaba's now been selling data in terms of for beauty products into European companies, so they can create products that there's demand for, sell those into China. And it's that type of product that BWX has got with the Sukin range. Especially, there is a big demand for, organic products and products that, for example, the product that was created out of Alibaba's research was a product that's actually counters the effects of pollution, which is doing quite well in China because there is so much pollution and people are concerned about that. And it's a similar theme with the BWX product. It is organic components that are going into the Sukin range. And the sales are still quite strong in the business, so we still think it's a good business there. We'll keep an eye on it, and hopefully we get a chance to enter back in once we're comfortable that the business will go well without the key guy inside the business. And just a new position that we've got, Mastermyne. So we've sort of given you something that we got wrong, also something that we've owned for a little while. It's controversial, and Mastermyne's a new position that we've bought.
So we've bought in recently. You can see from the chart that the Mastermyne was in a world of pain, along with a lot of resource stocks and a lot of mining services companies of similar tail across the segment. It kind of cut costs like everyone was doing, and then we saw the coal prices start to rally. And then, of course, now what we're seeing is that coal price recovery is driving industry growth, old mines being revised, new development happening. And, we mentioned before that we're looking at different commodities. Coal is clearly one of them. And you can buy a resource company themselves, a coal business, or sometimes you can get great access via the mining services company. In fact, sometimes you get better certainty because they're contracted, and they've got a long tenure of work. The company had a really clean result, great cash flow. They increased the level of contracted work and the pipelines quite strongly. The margins in their guidance are solid, and we've decided that we wouldn't mind getting in. They're an underground coal mine operator. They don't typically supply the gear. Most of that's hired, and we think they've got like 3 years of growth from both the contracted work plus the market momentum. And there's not a lot of competition around. A lot of the competition they faced in the previous cycle has kind of disappeared. So, they're in a really good position, and it's pretty cheap.
And the other thing I guess we liked is how the idea came about. Is we've actually been talking to a lot of their clients who all said quite favourable things about them. So that put us in a favourable disposition where you've got clients who are actually, saying that they're great operators. They perform well on site. There's not, any risk in terms of execution with them. So we liked that factor, and the business had very good fundamentals. So we had a sort of bit of third-party validation in terms of their performance with their clients. Just in terms of outlook and how we're seeing things, Look, we think that there's a lot more companies who were expensive. You know, we run a pretty big watch list. It's got about 250 companies of businesses that we like, yet they don't seem to trade at the valuations where we'd want to buy that company at. And if you think back to that slide we had in here earlier on about that drawdown, you know, there's quite often a stock might have, you know, a negative 12-month performance, but end the year up, you know, 12 or 6 months later, with a positive return. So waiting for those periods where you can get attractive businesses at reasonable valuations, because quite a lot of the return comes out of executing well. So we try to be patient. You know, we're keeping our eye on quite a lot of stocks. What we've got coming up is AGM season, where we think that, you know, those businesses that have sound fundamentals, there'll be further reinforcement of their trading conditions and their outlook, and we think they'll provide a bit of a positive catalyst to the small cap market. The depreciating Aussie dollar is good for Australian businesses exporting, so we think that that's gives them quite a strong advantage internationally, and is good for the economy. And there are quite a lot of Australian companies. This is a bit of a change from historically that are growing internationally. You know, we mentioned Afterpay, and you know, there is the potential for that to become, you know, like the American Express of the millennials. When we model the business, we only model in half the current margin that they're getting. So if there is sort of colloquial feedback that they're going to get margin pressure internationally, or that everything comes from late fees, we actually don't model any of that in, and we still think it's an attractive business. And resources and materials, we still think will do well going forward. You know, and if you look at long-term charts of those things, while they have a very strong 12-month return, in the last couple of months has been a little bit weak, we still think they're still at quite depressed levels from where they have been historically. The majors are spending big money in terms of exploration and developing new projects. That augurs well for mining services, which is generally how we tend to play this, but there is massive cash flow coming into some of the smaller resource players who, you know, have got very low risk type projects. So overall, we're reasonably comfortable with how things are going at the moment. The volatility, we're just more looking at as an opportunity to pick up stocks. We don't think we're going to get into a fully blown bear market. We think amongst the small portfolio of companies that we own, they are all priced quite attractively and have good outlooks. So while we will get caught up in shorter term noise, we have been taking the opportunity to top up some of those more favoured positions of ours.
I mean, it's interesting back in, and this is obviously a very severe market correction this month, but if you look back prior to May, and then if you look at prior to the May, and then we had the Macquarie conference, which came out and confirmed that businesses were going well when the market was doubting that. And then again, before the reporting season, where the market was doubting itself and then the reporting season was strong. There's a lot of businesses that are actually performing well because of some of the structural things we've talked about today, and we suspect that most of them will come out and say, you know what, things are going pretty well. We've already had some AGM commentary, and it sort of ranges from benign to reasonably good. So we don't expect that should change. The market's clearly been driven by international markets at the moment, and I think one day it'll come back to fundamentals, and that's where you make your money.
Okay, so just moving on from that, just a quick summary of what we've got. We have geared up our marketing a little bit this year. Obviously, we're doing these webinars quarterly, giving a review of the last quarter and trying to be transparent with shareholders. The annual general meeting is on the 15th of November, and you don't have to be a shareholder to come to that. We give a bit of an update on how we're seeing things at that period of time. And for the first time this year, we're doing a national roadshow. So we've got the dates there. You can get the dates of all of these off our website, and there's a link to get to attend. So you'll put an event in your diary and give you all of the address details. So if you want that, go to the event section of our website. In terms of shareholder communications, we're still doing our weekly newsletter. As some of you will see, if you haven't got it, please go and subscribe to it. You know, we try and keep people fully informed about what we're doing and positions in the portfolio and how we're seeing the market, as well as getting the ASX announcements. There is quite a lot of information on our website, which has got a blog on it, and we're doing a little bit more on social media if you want to follow. Thank you, everyone, for joining in. And as I said, just remember that we have got a couple more events coming up, which are all on the website, so you're quite welcome to join any of those. So thanks for attending.
Thank you very much.